Tim Gramatovich, the Advisor Shares Peritus High Yield ETF, the HYLD, offers a higher yield around 10.5% compared to 8% for some of its competitors. How do you pull that off?
Well, we're really seeing a bifurcated marketplace today, where you have on-the-run, liquid primary deals that are trading at, again, sub 5-6% handles, versus a secondary market where we have an opportunity to be very, very active and very, very selective. So the market offers us a significant opportunity. Active credit pickers, it's a great market.
And you also tend towards a shorter maturity. Why is this beneficial for investors?
Well, we let the portfolio really drive that result. We have a significantly shorter duration or interest rate sensitivity in the portfolio, and we also have a shorter maturity. But it really is a segment of the marketplace. We let the portfolio drive the stats rather than dialing in stats.
So what's in the portfolio? What are some of your favorite sectors? Maybe an issue or two?
Sure. Well, right now we're not seeing anything from an industry perspective that is dramatically undervalued. We've snooped around in the gas space, we've snooped around in the coal space, nothing really, really cheap there. We've added a couple of names here and there, but I think for the most part, give you a couple of controversial names, if you will. We don't shy away from that. Navistar being a great example that's in the market, where Carl Icahn and his former Lieutenant Richesky own 30% of that company. There's another 18% player in Fidelity. Three guys own basically half the equity. There's going to be a transaction there. And so for us as bondholders, we were able to buy bonds at a nice discount to par. And when, which we believe ultimately a transaction is going to happen with Navistar, we're going to be able to put those bonds back to the acquiring entity at 101. And we own the bonds pretty cheap in the low 90s. So that would be an example. Another company that we love, Energy Solutions, ticker is ES. Again, real basic business, nuclear, it really is a nuclear waste disposal company, and pretty good business model, economically insensitive as we would imagine. And you've seen some pretty big management changes, an earnings miss on that business. Again, bonds trading from 103, 104 all the way down to the low 80s. We like the business, it's not going away, and we have some new management. So that would be two very, very eclectic names that we would own in the portfolio.
And finally, speaking of the sensitivity of the economy, what do you see as the default rate for the rest of 2012 and 2013? Because this is something you look at when you're investing in high yield.
Right. It's our primary risk as investors in high yield. The bottom line for us as it relates to the default issue is that as an overall market, we're just not going to be seeing a great deal of defaults in 2012 or 2013. We've seen a liquefaction of the cycle. We've seen huge refinancings coming in, and you're just not going to have that. So I think that we're going to be probably sub 3% or well below normal over the next couple of years in our asset class.
This market has fewer players.
We're coming into a Monday where we're
would enter in a new stage of tech.
It's a stock picker's market.
Welcome to the 5 dumbest things.
Apple reported earnings.